Source code speaking. Silver is green today. The chart looks calmer. The bounce is giving people permission to breathe again, and that is exactly why this moment is dangerous. Because a green candle after a violent drop does not mean the damage is repaired. It means the damage is being covered. It means the screen is showing you relief, while the structure underneath is still taking hits. And if you hold SLV or PSLV, you need to understand this right now. Not tomorrow, not after another move, right now. Because the real story is not the bounce. The real story is what happened underneath the bounce while most people were staring at the price and telling themselves the worst must be over. A lot of holders are doing the same thing today. They watched silver get slammed. They watched it fall hard in a very short window. Then they saw the rebound start. And the mind instantly reaches for comfort. Maybe that was the reset. Maybe weak hands are gone. Maybe the flush is finished. Maybe this is the turn. But price alone cannot answer that. Price can calm you down without telling you the truth. Price can bounce while pressure is still building somewhere deeper in the system. And that is what makes this setup so important. Because what happened over the last few sessions was not some clean, organic repricing based on suddenly changing fundamentals. It was a paper attack through thin windows, through futures pressure, through forced liquidations, through the kind of move that drags algorithms in and lets leverage do the rest. Silver had ripped higher fast. That kind of run always gets attention, big attention. The kind of attention that comes from players who are trapped on the wrong side of a move and know exactly how to use paper to create panic. So the sell-off came in fast, it came in hard, and it created exactly what it was supposed to create: fear, confusion, and a reason for retail to stop asking what was happening behind the curtain. Now today the chart is green again, and for most people that is enough. But a bounce after a sharp break does not reverse the break. It just interrupts the emotion of it. If something falls 10 and then recovers 4, that is not restoration. That is partial repair at best. The market is still carrying the wound. The distance back to the highs is still there. The damage still exists. And when a bounce becomes the headline, it distracts people from the question that actually matters. Not what silver did on the screen today. What happened inside the system while that drop was unfolding? That is where this gets serious. Because while the price was getting hit, the delivery side of COMEX kept moving. And the delivery side is where the story stops being emotional and starts becoming mathematical. Going into this window, registered silver inventory was already under strain. Not total silver connected to vaults, not every ounce somewhere in the ecosystem. Registered. The category that is specifically tagged and available for delivery against futures contracts. The category that matters when someone says, "I want the bars." That number was already down hard from where it had been months earlier. Pressure was not beginning here. Pressure was already in place before the first major March notices even started to matter. Then came the moment that changed the tone. A large number of contracts stood for physical delivery. Not cash settlement, not roll it forward, not maybe later. Physical. Real bars, real ounces, real claims on available supply. That alone got attention. But what is even more important is what happened immediately after. In just the first 3 trading sessions following first notice day, the amount of silver already delivered surged past the entire total for the previous month. Think about how absurd that is. Not a slow month, not a dead month. A month that had already been called historic. A month many people described as a record event. And then March, in only 3 sessions, ran past it. That is not noise. That is not a quirky data point. That is a message. And the message is that the bounce on your chart is hiding a rate of physical draw that should make every serious silver holder stop and pay attention. Because when a system is delivering that much metal that quickly, you are no longer looking at a casual flow. You are looking at pressure that has speed. You are looking at pace, and pace changes everything. One big headline number can be dismissed. A fast sequence cannot. A strong delivery day can be called an outlier. Multiple sessions that stack on top of each other and outrun the prior month change the conversation entirely. Now the question becomes simple. If that pace continues, how long does the remaining registered inventory last before the numbers get uncomfortable for everyone pretending the screen is the only thing that matters? I am not telling you that the vault goes to 0 on a schedule. I am telling you that the current rate forces people to ask the question. And once the market starts asking that question seriously, the bounce becomes background noise. Because both things can be true at the same time. The price can be up today, and the drain can still be happening. The green candle can be real, and the structural stress can also be real. Those are not contradictions. They are parallel events. One is the paper reflection you see instantly. The other is the physical pressure that builds until the paper market can no longer comfortably ignore it. That is the entire issue here. Most people only react to the first one because it is easier to see. Very few people follow the second one because it requires work, context, and discipline. But the second one is usually the one that matters more when the system gets stretched. Now let us talk about SLV, because this distinction matters. If you hold SLV, you are holding an instrument that tracks the paper price. That is the core reality. When futures get smashed, SLV responds. When paper rebounds, SLV responds. It is directly tied to the reference mechanism that the futures market creates. So when the paper market is being pushed around aggressively, your position lives inside that volatility, whether the physical silver backing the broader trust structure is changing or not. That is the exposure. The issue is not that every ounce behind the structure suddenly disappears. The issue is that the quoted value of your position can be jerked around by a paper mechanism that does not care whether the physical story is tightening underneath it. And that matters right now, because this is where people make costly mistakes. If the bounce fails and another paper wave hits, a lot of SLV holders will be tempted to treat that move as truth instead of mechanism. They will think the breakdown means the thesis is broken. They will sell into a paper-driven flush, even if the physical strain underneath has not eased at all. And then they lock in the pain at exactly the point where the paper market has done its job. It has shaken them loose before the structure has had time to resolve. That is the trap. The paper market moves first. The physical market speaks slower. But when the physical side finally forces repricing, the people who got shaken out during the engineered volatility are already gone. That is what makes holding SLV psychologically demanding. You are living in the reference price all the way through. The dumps, the snapbacks, the fake relief, the real repricing later, all of it. Now compare that with PSLV. PSLV is not magic. It is not immune to short-term price swings. If spot gets hit, PSLV gets hit too in quoted terms. Let us be clear about that. Anyone telling you otherwise is selling fantasy. But the structure is different in a way that matters more as stress rises. The underlying metal is fully allocated, audited, held in a structure outside the exact delivery mechanism currently being drained. That means the bars behind those units are not participating in the same immediate pressure event that COMEX registered inventory is going through right now. The quoted price can still swing because the market references silver the way it does. But the bars themselves do not start vanishing because paper got dumped in New York. That difference is not cosmetic. It is structural. And in a period like this, structural differences matter more than slogans. Because when the market begins to care about verified, allocated, auditable physical silver, the conversation around PSLV can change quickly. We have already seen what that looks like in prior stress events. A trust trading below the value of its underlying metal can flip sentiment once buyers decide they want exposure to the real thing, not just exposure to the paper reference number. That shift does not always happen instantly. It does not arrive on command. But when it does happen, it changes behavior fast. The discount matters, the structure matters, the credibility of the underlying metal matters. And all of that starts mattering more when COMEX is moving huge amounts of silver out the door in a compressed period. So right now you have two realities sitting beside each other. You have a bounce that is encouraging comfort, and you have a delivery pace that is encouraging scrutiny. That is why this moment matters. Because the market loves to make people feel safe right before it forces them to look deeper. Now here is where I want to slow down and focus on what you should actually watch from this point forward, because this is where discipline beats emotion. First, watch registered silver inventory. Daily, not casually, daily. That number tells you whether the pressure is easing, stabilizing, or intensifying. If registered continues to slide while the delivery window remains active, the market is being handed a very different message than the one the green candle is selling. If that inventory starts pushing through levels that already look historically stressed, the conversation changes from "this is unusual" to "this is something the system may not want too many people focusing on." That is why this number matters so much. It turns the story from opinion into arithmetic. Second, watch the delivery pace itself. Not just one headline total, the daily rhythm. Is the market still seeing meaningful contracts move into delivery? Is the speed staying aggressive? Is it slowing? Is it accelerating? Pace tells you whether the first burst was front-loaded or whether something deeper is happening. And if pace stays hot, then every bounce in price has to be evaluated against a physical drain that is still ongoing. That is the key. A bounce without a slowdown in drain is not reassurance. It is camouflage. Third, if you hold PSLV, watch the discount to NAV. That number matters because it tells you how the market is valuing the structure relative to the silver it represents. A discount can persist, but if that discount begins to narrow while COMEX stress stays elevated, you are watching trust in verified physical exposure rise in real time. And if it flips to premium, then the market is sending a very loud signal that it wants physical certainty more than it wants theoretical exposure. That is not a small shift. That is a change in preference. And changes in preference often show up before the broad crowd understands why. Fourth, keep an eye on the next active contract buildup, because one intense delivery window is important, but a second one building behind it tells you the issue may not be isolated. If the next contract starts absorbing open interest in size after everything the market just witnessed, then this is not just a one-month event. That would suggest the pressure is carrying forward. And once the market starts believing that physical demand is not fading, every paper flush becomes harder to trust on the downside. Fifth, do not ignore geopolitical risk. Silver did not move in a vacuum. Conflict, shipping disruption, energy pressure, fear in broader markets. These things can compress or expand the premium built into price very quickly. One calming headline can take air out of the move. One escalation can put it right back in. That means you cannot reduce this story to only vault math or only price action. You have to respect both. Because if physical stress and geopolitical stress start reinforcing each other, the market can move much faster than people expect. Now let us be brutally clear about the bottom line. Today's bounce is real. But it does not erase the fact that an enormous amount of silver has already moved through delivery in an extremely short time. It does not erase the fact that March, in just a handful of sessions, outran an entire month that was already being called historic. It does not erase the fact that registered inventory was already weakened before this window even began. And it definitely does not erase the fact that most people looking at the green candle have not taken 10 minutes to understand what is happening underneath it. That is the opportunity and the danger at the same time. The opportunity is that the real signal is still being ignored by a lot of people who think price alone tells the whole story. The danger is that if you let the bounce relax you too much, you stop tracking the thing that matters most. If you hold SLV, understand the ride you are on. You are tied to the paper reference system in both directions. That means you get the upside if physical reality finally forces repricing. But it also means you must survive the manipulative swings without misreading them. The biggest mistake here is not volatility. The biggest mistake is treating paper pressure as final truth before the physical side has finished speaking. If you hold PSLV, understand what you actually own. Your short-term quoted value can still get pushed around, but the structure underneath is different. Allocated metal, audited, outside the exact registered drain everyone should be studying right now. And if the market begins to favor verified physical certainty again, that structure becomes more important, not less. This is the part where weak analysis usually gives you comfort. It tells you the bounce solved the problem. It tells you green means healing. It tells you to stop worrying because the market has spoken. But the market has not finished speaking. Not even close. The chart gave you one sentence. The vault data is still writing the paragraph. And if you make your decision off the first sentence while ignoring the rest, you are playing the exact role this kind of move wants you to play. So do not let the bounce hypnotize you. Do not let one green day erase what happened in the last 3 sessions. Do not let relief become ignorance. Track the inventory. Track the deliveries. Track the PSLV discount. Track the next contract. Track the geopolitical pressure. Because this story is not over. The move you just saw may end up being remembered as recovery. Or it may end up being remembered as the candle that distracted everyone while the real damage kept building underneath COMEX. And that is the question now. Was today the beginning of repair? Or was it the pause that let most people stop looking right before the data turned even more serious? That is what this week is going to answer. So stay sharp, stay honest, stay focused on the numbers that most people never check. Because the chart can calm you down, the chart can lie by omission, but the drain does not care how comfortable you feel. The drain is either happening or it is not. And right now, based on the pace we have already seen, that is still the story that matters. If you are still here, ask yourself one thing. Are you reacting to the bounce, or are you responding to the structure? Drop your view in the comments, SLV or PSLV, and are you holding, adding, or watching? Subscribe for the next update because this window is still active, the numbers are still moving, and the next few sessions could decide whether this green candle was reassurance or a disguise.